Hey guys, my name is Nicolette Mashile. I am also known as the Financial Bunny. Welcome to the Financial Bunny TV. So in the news has been quite a big conversation around the retirement industry is the fact that Parliament Committee on Finance wants the two-pot system to go ahead by the 1st of March 2024. However, we know that National Treasury and some people within the industry are pushing back. But this reminds me of a trip that I did last year with Alex Forbes, where we went all the way to Livingstone in Zambia. And basically, it was a conference around retirement benefits, right? And in that specific conference, there was a couple of young people that were in the conference. We're discussing retirement benefits and why we need to encourage more Africans to actually start saving up for their retirement years. And one of the things that came out, I think it was from a Zambian youth, he said, well, look, we are being charged by our banks up to 33% on interest rate. Now, if I'm saving up for retirement, why am I not allowed to use my retirement to be able, or my retirement savings rather, to back up a loan from the bank? Because if there's something, if I default on it, then at least we can use those retirement funds to be able to settle the house, or at least use it as collateral, right? And I thought about how even in those countries, you don't even have to buy a pension when you get to your retirement years. And I thought a little bit about the South African landscape, and I just thought, you know what, now that the two-pot system is back again in the news, and we are hoping, or in fact, we might be looking at a go-ahead date of the 1st of March 2024, it might just be very important for me to go into that conversation. But before I get into it, please do remember, none of my videos constitute as financial advice. If you are, however, looking for financial advice, please speak to somebody that is certified and registered with the FSCA. So maybe it's very important to start off with, why was the two-pot system even proposed, right? It's a draft legislation that obviously changes how the retirement funds will be administered going forward. Basically, the first one is the fact that they wanted to give South Africans limited access to their retirement funds for emergency purposes. I'm guessing what happened during COVID showed the government that, you know what, people can lose some of their material possessions, can lose even some their income for well-being simply because they don't have liquid cash, but most of them have huge retirement funds that are sitting there and they can't access that money. So that's step number one, right? Emergency purposes, and it's a limited access to it. The second one was, of course, to preserve retirement savings for retirement years. What we're finding that if you don't want people to be dependent on the state, you need to encourage them during their working years to save up for some retirement money so that they're able to actually fund their lifestyles in retirement. So the two-pot system is basically supposed to answer that. What it says is that there will be two pots where you are going to be contributing your retirement contributions to. The one is a savings pot and the other one is what is called a retirement pot. 1/3 of your contribution will go to your savings pot and 2/3 will go into your retirement pot. If you remember, the current legislation is that when you get to retirement, you get 1/3 as a lump sum and the other 2/3 you got to buy an annuity. So that kind of still is there. With the savings pot, you are allowed to withdraw once a year as long as it's a minimum of 2,000 Rand. So you've got to fund that pot up to 2,000 Rand first, and then only are you able to actually withdraw. And you've got to withdraw, obviously, at a minimum of 2,000 Rand. You're only allowed one withdrawal in a financial year. On the retirement pot, 2/3 of your contribution goes into that, and you can't touch that money up until you get to retirement. And when you get to retirement, that money needs to be used to buy an annuity, basically to buy you a pension. So you'll hear a lot of people go see bahola umdende, or they're going to earn a state or a state provided pension. This is to create a privately provided pension by yourself so that you don't get to the point where in retirement you are coming up and you are dependent on the state to be able to pay you some money. So you still need to use that retirement money to buy an annuity, so you're not going to get it as a lump sum. However, if let's say you do not withdraw, or you actually have saved quite a huge lump sum in your savings pot and now you are in retirement years, you are allowed to withdraw that money, of course, as a lump sum when you're also in your retirement years. If you withdraw before, obviously tax is going to be applicable. If you withdraw that emergency once a year withdrawal, you will be taxed, and that money that you withdraw, so withdrawals, will be treated as your normal income that you're going to be making in that year, and then it will it makes it tax neutral, basically, is to charge everybody at their own tax rate. So if you withdraw it, you will get taxed based on it as your income, total income of that year. There is, however, another pot, because people keep asking, so what happens to my current retirement savings? There's a pot called the vested pot. And basically, up until the 1st, or probably the 28th of February, 2024, that pot will become your vested pot. So all of your money that is in your current retirement will go into that pot. What you're allowed to do is to transfer, I think, 10% of whatever the total is there, or up to 25,000 into your savings pot. And then the rest of it, of course, will still be treated with the old or the current now legislation of how retirement works. So that's essentially what we're being said. And a lot of people are saying, okay, can I transfer it? And I guess that's probably one thing that many people would want to do, is to transfer the 25,000 or up to 25,000, 10% into their savings pot, and then the other money will go into their retirement pot. But the rules will only apply to money that is contributed. The new rules, the two-pot system rules, will only apply to money that is now contributed from the 1st of March 2024. Any other monies and contributions will still be regulated under the current retirement laws that we've got in South Africa. So it's very important to understand this. Of course, we're hearing National Treasury and most of the guys in the industry saying we're not necessarily ready. Obviously, the one big portion of this, or the one big party that needs to be ready for this to actually go live, is of course SARS, because it's got a whole new tax law that needs to be kind of amended to be able to take care of retirement contributions and how retirement contributions are made. Very important to understand these types of things. Of course, if you are running your own or managing rather, or administering your own retirement annuity, it'll be very important for you to understand these things so that you can go and sit with your financial planner and figure out how does it look now going forward. Also keeping in mind the fact that you may be allowed to be able to withdraw from your savings pot once a year for emergencies. So you might even want to ramp up your actual contribution figures. The nice thing is that 2/3 of it will still go to your retirement. And ultimately, I think sometimes we argue that, South African government is coming up with weird laws and what. But I think this is it's a good step in trying to make sure that we're preserving people's retirement funds and also still giving them a little bit of limited access to their retirement, especially if, let's say, you are going to be resigning and there's a gap between you resigning from a job and moving to the next one. If you have, of course, contributed enough money into your savings pot, you are allowed to withdraw that money to cover you for emergencies, which would be an emergency. You know what I mean? If you're covering for a whole maybe 2 or 3 months of you not starting your new job with no salary, that can help. And I like the fact that it's limited to the fact that in that savings pot, only 1/3 of your money will actually go into that pot and the rest will go to your retirement. I think it's a good move. But of course, it does require us to contribute enough money to our retirement in the first place and not to disturb that. With the new retirement law, you will not at least disturb 2/3 of your money that you're contributing. So that's why I'm quite positive about it. Yes, there's obviously flaws in it and huge criticism, but for me, I think it's a good move that the government is making, considering the fact that I've also looked at the context of other African countries and how they are treating their retirement savings. So yeah, let's see if we are going to go live on the 1st of March 2024. But please do remember, none of my videos constitute as financial advice. This video was not financial advice. It's simply for educational purposes. I'll see you guys on the next one. Mwah.